So hello everyone, welcome to our last session, which is part of Commodity Week. I would just do a video and a mic check. Neeraj, am I audible as well as visible?
Yes, clearly.
Perfect. So thanks a lot. You have been a great participant. The audience has been great, and our previous 5 sessions were awesome. We started with maize, went over to wheat, then rice, soybean, peas, and today we are talking a very important commodity, that is sugar. And as usual, we are having great speakers from all across the world today deliberating on the overall sugar ecosystem. As we move forward, let me first share my screen and just go through initial introduction as well as some numbers, which we would be further discussing as we move forward. So as you see, we are having an awesome panel today. We are having Kona Haque. She's be helping us in understanding the overall global markets, both the macro at micro level. We would be followed with that by Mr. G.K. Sood, who is eminent agriculture economist and one of a very strong voice for more than half a century in sugar. Then Mr. Sanjay Sacheti, who is country head of Olam. Then we'll be having eminent speaker, Mr. Kiran Wadhwana, who will be talking about sustainability. Again, a very strong voice. Followed by Mr. Willis Agwingi. He'll bring the African perspective. And last but not least, Mr. Ravi Gupta, who is executive director and chairman of Shree Renuka Sugar. And humbly myself, your moderator, I'm founder of HnyB. So let's get the numbers out first. As I said, we'll be talking about sugar and ethanol today. So the global game is very simple that we are estimating that there would be 122 million metric tons of sugar, which was estimated to be produced in 2025, derived mainly from sugarcane and sugar beet. We all know that Brazil, India, European Union, Thailand, China, and United States, they are among the leading producers. Going to ethanol, which is again, I would say, deeply entwined with sugar, ethanol. So we are looking at 117 billion liters of ethanol being produced in 2025 with United States, Brazil, European Union, China, and now India also catching up because of our own E20 that is blending in fuel policy. So India blends 20% ethanol in their petrol. Of overall ethanol production, 60% of that comes from grains, predominantly maize, and also in multiple countries of, I would say, damaged grains like rice and wheat, and 40% coming from sugarcane and molasses. By 2035, we see a substantial increase in the demand for ethanol because of various blending mandates, decarbonization goals, and definitely industrial use is also increasing. And we'll need close to 150 billion liters of ethanol by 2035, that is 10 years from now. Over the past 6 decades, we have seen that yields have improved in sugarcane from roughly 45 tons per hectare in 1960s to close to 70 tons per hectare today. While sugar beet yields have grown far, I would say, in a more robust manner than sugarcane, from 25 tons per hectare to roughly 65 tons per hectare as of now. Overall, if you see the world, 26 to 27 million hectares globally are used for cultivating sugarcane, while sugar beet cultivation is in close to 4 to 5 million hectares. If you see India, again, very important, both as producer as well as the consumer of sugar and ethanol both. So we are seeing sugarcane production in 2025-26 to be close to 440 million metric ton because of very good monsoon we had. And we are also seeing that currently the crop is doing pretty well, which translates into roughly 35.6 million metric ton of sugar output, which will diverted, a part of it would be diverted to ethanol as well. Domestic sugar consumption is gonna be as good as what it used to be last year or before last year, around 28.3 million metric tons. As far as ethanol production is concerned, the mandate, which is the oil marketing company purchase from the distilleries, is roughly 10.5 billion liters. And that is, as I said, that to meet 20% blending target. And a substantial part of it that would be coming, in fact, 71% of that would be coming from grains, and roughly 28.5 to 28.8 percentage coming from sugarcane, molasses, sugar syrup, and all that. Sugarcane is cultivated in 25-26 close to 5.7 to 5.9 million hectares. Now let's see some of the supply and demand numbers. So global S&D looks pretty strong. So we started 25-26 season at 43.1 million metric ton as carry, which was a little bit lower than the previous year, but that happens in sugar globally, that you have between 42.8 to roughly 46 million metric ton over past decade. That has been typically carry. So carry looks as good as last year. Production, a little bit of improvement, and improvement of close to, if you see that, 3 million metric ton. And a substantial part of that is coming from India, because India is expected to have pretty decent 25-26 going forward. In fact, even 24-25, we had a pretty decent numbers. Global trade is roughly 65 million metric ton, and that has also been remained predominantly flat. So supply as good as last year. Last year it was 228.1 million metric tons. This year we are looking at again 229.1 million metric ton. Usage, there is slight decrease in that, but as I said, we have seen that past 2 or 3 years. In fact, in 23-24 or in 22-23, because of some hike in prices of sugar, the demand went a little bit low, but it is coming back. Ending stock again 45.1, as good as I would say that was in 23-24. Ethanol wise also, you see that typically carry ranges around 4 billion liters, plus minus 0.75 billion liters. Production, yes, that has improved. That is a very good sign that because of various mandates, there is a diversion of grains and again both sugar syrup and molasses in production of ethanol. So ethanol, we are looking at 122.6 billion liters of ethanol being produced in 25-26 season. And if you see that the production has been growing consistently from 2022-23 number of 110 billion liters, we have reached 222.6 billion liters. And moving forward, as I said, in next 10 years, we should be reaching something around 150 billion liters. Global trade has also increased. It is now 12.6 billion liters. Predominantly, ethanol production is for domestic consumption. But of late, we are seeing that in some of the countries, because of the environmental mandates, and because of the blending, suddenly we are seeing that the global trade is increasing. In fact, it has increased by more than 20% when we compare it to last year. Supply side, pretty decent, 126.6 billion liters. Usage, 122.4 billion liters. And then ending stock of close to 4.2 billion liters, which was as good as the last year. When we talk about the raw material, which is being used for sugar and ethanol both, so if you see sugarcane, a pretty decent crop in Brazil. In fact, there is an increase, in production from 690 million metric tons to 710 million metric tons. Same in India, from 390 million metric tons, we are looking at 430 million metric tons. Sugar beet, if you see that there is a very slight increase in European Union and Russia, not much of significance. But at the same time, if you see that maize production, which is also used in ethanol, we already had the first session of Commodity Week on maize. There you see that there is a substantial increase. So a lot of maize is being produced, and a large part of that is being used for the increased demand of ethanol. So ethanol demand from sugar, cane, syrup, and molasses is not growing that much at what you see from grains and especially maize. Now let's take a little bit of Indian context. So carry was less than last year, because last year we found that we were pretty short when it came to production. 28.7 million metric ton was the overall sugarcane production. I'm talking about 2024-25 outputs. And supply, because of higher carry from 23-24, was able to take care of our overall demand of 28.2 million metric ton. This year, that leads us in a situation where, because we are having 35.5 million metric tons of production expected, there is a huge chance that we'll be having glut, that is oversupply. So the overall supply situation just for sugar looks at 39.4 million metric ton. Sugar production out of that would be close to 30.5, and 3.5 million metric ton looks at diversion towards ethanol. So if you see the diversion of sugarcane to ethanol, or sugar equivalent to ethanol, has been pretty flat. And this was the reason that in 2023-24, when we were anticipating that the 24-25 crop is not going to be great, the government came with a strict policy of stopping the movement, or banning the conversion of sugarcane syrup and molasses to ethanol. And that's you see a dip there in 23-24. Otherwise, actually, it has been pretty flat, 3.7 last year, and 3.5 is what we anticipate this year. So 28.3 is the use of pure sugar. Export, Government of India has opened quota last year also for a million metric ton, but overall export was only 0.8 million metric ton. This year, again, they have given quota of roughly 1.5 million metric ton. So we'll be having a comfortable closing stock of 4.6 million metric ton. Now, this is the OMC, that is Oil Marketing Company, which do the blending in India. So if you see off late, they are pushing for grain. So grain-based ethanol has increased from 2.2 billion liters to 7.3 billion liters in 25-26. And if you see that, as I was telling you, that diversion of ethanol to sugarcane to OMCs has been flat, 3.3, 2.63, 3.2. So it's pretty in range of, I would say 15% plus minus 3 billion liters. So with that, actually, I would like to end my own discussion, and I would like to get into discussion with my esteemed panelists. So first we'll have Kona. She is extremely, I would say, influential individual when it comes to sugar industry. So can I request you to start your video, Kona? Okay, perfect. Thanks a lot, Kona, for joining us. So I'll just give an introduction about Kona, though I'm pretty sure that most of the people who are watching this live telecast would be knowing about her. She heads the research at ED&F Man, and she's one of the most respected voice in the global soft commodity sector. So head of research at ED&F Man, a historic titan in the sugar trade, she leads the intelligence division that guides billions of dollars in trade flows. Kona is renowned for her deep macroeconomic analysis, connecting the dots between energy prices, currency wars, and global sugar balance sheets. Her expertise is critical for understanding the structural shifts, whether the 2026 surplus is a temporary weather event or a permanent realignment of global production capacities toward Brazil and India. Welcome, Kona. Pleasure to have you.
Thank you very much. Thank you so much for inviting me.
So, Kona, I'll straight away get into the first question. It's very important because we have been talking this surplus so many times when it comes to sugar. And if of late, if you see even the markets, right, they are reacting that way, that the last year, the prices, right, whether we are talking about US or whether we're talking about London white, right, they have been pretty lower than what exactly same time, right? I think they are down by 20%. And if you see that the 1 year high, they're substantially below that. And I think it's something around 14.89 odd cent per pound is what's going on. How do you see that this challenge where actually the balance sheet of 2026 look huge surpluses in some of the very important economies like India? Is this driven by genuine recovery in production or a structural slowdown in global consumption due to health-driven situation? Or do you think just a great weather which has led to these productions?
Okay, sure. So yeah, I think this surplus for the 25-26 season has been flagged for a while. The fact that in calendar 2025, sugar prices of New York collapsed by roughly a quarter, maybe even a little bit more. That was a reflection of the fact that the markets were anticipating this surplus in this current season. So they started to, we saw sugar prices start the 2025 in the high teens, nearly 20 cents per pound, and then collapsing all the way down to as low as 13.9 at one point. At the end, the season ended at about 14, 15 cents per pound, which is roughly where we are today. Now, so as you mentioned, the surplus has been very much anticipated. Arguably, it's already been priced in now. So the quantity of how big that surplus is varies depending on who you ask. Some see it as high as 8 million. I've heard very recently, I heard one entity talking about a surplus as big as 12 million bags, 12 million tons of sugar. We are nowhere that high. We're much more lower, at around about the 4 or 5 million tons. But it is still a surplus nonetheless, and it's a surplus that hasn't been seen in a few seasons. The reason why sugar prices were so high prior to this current season is because we were in a deficit. So after, a combination of deficits and balanced markets for the last 3 or 4 years in a row, has basically led to higher historical prices, which then in turn has encouraged higher planting, higher acreage, no matter where you look. So whether you're looking at India, whether you're looking at Thailand, whether you're looking at Brazil or Europe, all of the farmers and producers has responded to the previous 3 years of high prices. And today what we're seeing is a result of that supply expansion or supply response. India has, as you mentioned, will be seeing a recovery from the 24-25 season. That's because we saw previously the monsoons were bad in the previous season, but that would lead to the low price in 24-25. But subsequently, the monsoons have improved, which has allowed for increase in yields, but also the cane being a very favorable crop in terms of price attraction has also led to higher acreage. So so sugar production and cane production in India will definitely be up, not as high as what you're saying. And I think what we're going to see is, the impact for India is not necessarily the absolute production number. It's in terms of impact on the global supply-demand balance, it's always about whatever gets exported out of India. Now, yes, the government has allowed an increased export quota of 1.5 million tons, but how much of that actually gets exported will very much depend on the export parity price, so the domestic price in India versus the world market price. And at the moment, that is not connecting. So we've seen some exports to neighboring regions within Asia, but also in the Stans and Africa. But I think to see more wholesale expansion in exports out of India, you will need to see the domestic price higher, domestic price lower, or the world market price will have to rise to a level to extract that out of India. When it comes to the other the biggest titan, if you like, in world sugar, it's Brazil. Brazil had a variable weather in 25-26 crop so far. The weather's been more or less kind. Cane has been expanding in line with the last few years' favorable prices. But for initially, sugar prices were more attractive than ethanol. That's the optionality that the Brazilian millers have. And they were very much favoring sugar production. So it was a max sugar environment. It was only towards the last 3 months of the crop that ethanol prices started to rise alongside the falling stocks in Brazil. And the fact that global sugar prices started to fall. So now suddenly towards the end of the season, it's not quite yet done. We're seeing the ethanol parity. Ethanol is now commanding a higher premium over sugar. So Brazilian millers therefore are now looking to see where they start this. The new crop will start in April 2026. They probably will start with a higher ethanol mix initially, but then that could change quite rapidly. So some mills will have very good flexibility to divert between the two. I think one big factor for Brazil is the fact that you've got a higher proportion of corn-based ethanol, and that is something which is becoming a structural shift in the sugar and ethanol S&Ds out of Brazil. It's not something that we used to look at so much. Now, looking at corn ethanol is becoming very much part of an analyst's role as we start projecting forward for Brazilian sugar exports and sugar production. So going forward, I think that dynamic has to be looked at. Corn ethanol now accounts for about a third of total ethanol. So higher corn ethanol prices, production, low world sugar prices, the ethanol parity. These are all dynamics that have to be watched closely on a month-by-month basis before we can assess exactly how big the Brazilian crop will be. But for now, the weather looks positive, and I think there should be decent cane crop. The mix will also still be decently sugar oriented. So I think sugar out of Brazil will also be decent. Thailand will be good, but I think the low prices recently may start encouraging a shift later towards cassava. But for now, the crop is still good, even though it's lagging from previous years. And then Europe is a big producer of beet sugar. They've had an expansion because of higher yields as well. But again, looking ahead to the 26-27 season, I think the very low prices today, European sugar prices arguably are lower than cost of production there. I think you could start seeing some reduction in area in Europe for the 26-27 season, although today the crop for 25-26 is still pretty big. So all in all, we've got a surplus of about between 3 and 4 million tons. It's heavier than it has been for the previous 3 seasons, and therefore the prices are reacting accordingly.
Perfect, Kona. So I would like to continue on the discussion on Brazil. We have seen that the crude, right, that plays a very important role on that, how Brazil thinks about whether they want to have a higher sugar in the overall mix between sugar and ethanol. What are your views on crude? Because that has been looking too volatile, and it has been a lot of geopolitics around it with the recent actions of whether we talk about Venezuela or what's happening in Iran. So these are two very critical crude producing nations. And there we see, I'm saying that good or bad news both. I'm just looking at not a political angle, but purely on the production angle. Whatever happened in Venezuela, eventually it might lead to in 6 to 8 months or maybe 12 months, right? Higher production of crude from there. Similarly, what is going to happen in Iran, that will, in case it goes in a specific direction, there is a possibility the world market would get flooded, because very simple reason that the sanctions will go if the government shift happens in favor of the West. Do you see that actually people are keeping an eye on that as well? Because if these both things happen, which has one has already happened, second also happened, then we would be having glut in the crude as well.
Yeah, no, I think it's always worth looking at what's happening to crude. I mean, it is the world's most important commodity at the end of the day. Although arguably for sugar, the relation between sugar and crude over the past year and a bit, they've been pretty they haven't been as aligned as they have been in the past. So crude oil ended the year low. 2024-25 calendar year, you saw a very big collapse in crude oil prices. This was despite heightened geopolitical tensions, you name it, so much unrest in the Middle East, and yet, crude oil just continued to weaken. So we started this current calendar year with the expectations that the market was going to be very well supplied. There's a decent amount of non-OPEC surplus. There's a good amount of OPEC itself have been looking to increase their production. They were cutting back throughout the early part of last year, but those are all coming back onto the market now. China was a big buyer last year. This year, arguably less so. Now, the point about what you're saying about the geopolitical risks, and particularly what's happening in Venezuela, again, if you look at the last 2 weeks' events, so much headline news, and yet crude oil prices actually fell a little bit. The reality is that so number one, you're not seeing too much disruption out of Venezuela. That is more, the trade flow for China, who China is now having to divert and actually getting, for example, from Canada or other Saudi, for example. But it's more of a diversion as opposed to disruption. Longer term, though, or medium term, can Venezuela's production start recovering because of the US intervention? No, that's very heavy crude, and the infrastructure there is so behind that it's going to take years, by some estimate 2040, before you could start seeing a return to 3 million barrels per day out of Venezuela. Today it's roughly half of that. So you're not going to see a significant increase there in the short term. And if you're looking at what's going to happen in Iran, I think that's a massive question mark. But again, if you saw when Israel attacked Iran at the beginning of last year, there was so, that was kind of war event that in the past would have led to $10 per barrel premium, and you didn't see that happening. So I don't want to really make any guess at this point of how much disruption will happen. It's definitely something to watch. But I think my base case is that crude oil for the course of 2020-26 should on balance be around about the 60 to 60, maybe 58 to $68 per barrel level. So again, not too dissimilar to where we are today, but a little bit higher than where we were last year.
No, perfect. Actually, the interesting part is that if you see when in the past, when you used to have global turmoils, you used to have perishables prices shooting up, right? Agriculture, commodity, crude, and the metals used to take some time. First time we are seeing in 2025, where actually everybody, in fact, every region in the world was having uncertainty, political, as well as military conflicts. Yet actually the agriculture commodity prices crashed and the metal prices were just they went beyond. It's just about gold and silver, but even see most of the metals they perform very well. Now this brings me to another very important pertinent question when it comes to sugar trade. So if you see that actually we are already seeing that there is a speculative trade also happening, and that's a part of the game. So how much do you see that the current price action, which has been we have seen that pretty bottomed out over past 1 year, as you rightly said, that quarter, 25%, nearly 25% crash of sugar prices. How much of do you think it is driven by fundamental and it is because of algorithmic macro trading or the hedge funds who are trying to take away money out of from the market? So how much of you think it is a fundamental? How much of it is algorithmic and trading based fall? Or I would say that way, is the tail wagging the dog, the futures?
No, I think fundamentals will always be the fun, as they say, the fundamental crux of any market and any trading decision. And it's looking at these fundamentals that the funds will react to. So the funds were aware, and that's what they do. Their job is to anticipate because they trade the futures market. They need to look ahead. They want to be the first one in if there's a surplus. They want to be the first one out if they see a change in that. In terms of their positioning. So they must have seen correctly, I guess, that this potential surplus ahead, when they know that there are no weather risks ahead for Brazilian or Indian production, they quite safely start piling into the short position. So for much of 2025, we saw the funds hold a record net, almost a near record net short position. And they maintained that, even as coffee and cocoa and other fellow soft commodities we're seeing, massive net long positioning. They didn't change that. That soft sector was a massive discrepancy with sugar remaining very heavily net short, and they've maintained that despite the macro story being pretty supportive. The dollar was weak. The BRL wasn't particularly didn't sell off too badly. So there were the investors in the investor sentiment side of thing has been pretty positive, and yet they decide to stay short sugar. The contango in the sugar market clearly right now is a massive incentive for them to remain net short, but that wasn't the case for a while. So it really is this belief by the funds that the sugar prices are need to stay low in order to solve the surplus. And by staying short and prices then falling, that encourages the algorithm funds, as you mentioned, who follow the sort of momentum models, and they react to momentum. So if it's negative, they will continue to sell that because the price signals are to sell. But they also react to the spreads. So the spreads recently have started to move into contango, and I think that is encouraging also more selling. So they will only come out of their net short positioning if they see a fundamental reversal where they start to see weather issues in Brazil or India or Thailand, which should reduce that surplus, or the trade flow start to tighten. I think that's the only thing that could cause them to start covering their shorts. But for now, I don't see too much of a risk of that because I think there seems to be a bit of a consensus view that the markets are comfortably moving into surplus.
Perfect. No, totally understand. Like, this is where the funds have always been, like, in profits, irrespective of what happens to traders. So kind of coming to the last question, which is, I think, again, very pertinent question for the current scenario. Sugar really trades in vacuum. We all know that. Not just sugar, in fact, majority of the commodities, they don't trade in vacuum. So if we zoom out to the broader macro canvas, from federal policies and the strength of dollar to the geopolitical frictions, how much of the current price action is being driven by these external macro factors versus the actual physical surpluses? Because physical surplus has been talked a lot, but these factors definitely, like, in fact, currencies, like, Indian currency has appreciated all the way from 85 to now today, like, we would be close at 90.16. So it means there has been substantial fall in that. So, and other currencies are also behaving, like, not very stably. How do you see that, as well as, like, everybody is waiting on, like, how the Federal want to control the inflation, whether they'll be increasing or decreasing the interest rates. So all of them also have definitely impact, but how much that impact is having more profound than actually the physical availability of stocks?
So we are seeing a bit of a dichotomy here, because the macro environment, the investor sentiment right now is actually quite positive, which you wouldn't think if you saw the sugar market, right? The sugar market, the funds are still very short. So clearly, this is one area where the sugar market, or the sugar traders and speculators, are putting aside the positive macro environment and seeing a pretty bearish view for sugar. So they remain net short because they see bearish fundamentals. If you look at other commodities, however, grains that have been very weak, metals, copper and stuff have been going through the roof because of physical tightness. Oil, pretty well balanced, but I think there are some geopolitical risks there. So commodities as a whole, as an asset class, potentially will be quite attractive in 2026 because of a weak dollar. Why do I see a weak dollar? It's because we think that in the USA, the Federal Reserve will be cutting interest rates, not necessarily because the US economy needs to. I think the US economy is actually very resilient. It's more because I think Donald Trump will try and influence and appoint a Federal Reserve chairman that's going to be pretty dovish in his outlook. So I think there's pressure on him or her to put the Federal Reserve interest rates lower, which will weigh on the US dollar. But the global economic macro is actually pretty positive. I think, if in an environment of lower interest rates, stock markets that continue to go through the roof, this AI-led boom and positive sentiment there, the fact that, the world economy has been hit by everything from COVID to the Ukraine war to Middle East unrest to inflation, high interest rates, and it still continues to grow very resiliently. That to me suggests that we're starting 2026 on a strong economic foundations, and therefore investor sentiment will be pretty positive, and they will start. So it's going to be risk on. The environment is risk on, but risk on does not necessarily mean being bullish across everything. It means putting higher positions. So if they see that sugar is a bearish commodity, they will put additional risk in staying short the sugar market. So that is still a risk on move. And it's only when it's risk off, when investor sentiment is very shaky, that they take risk off the table for across the board, whether you're short or long, depending on where you are.
Perfect. So Kona, in fact, on a lighter note, do we also need to look at T factor? Because I think Mr. Trump, right, what he writes, what he speaks, how he acts, impact every possible market, right? In fact, I was talking to some think tanks in US, and he has come out with a new doctrine he called intelligence as an asset. So whether it is intelligence about the geopolitics, whether it is intelligence, or you talked about AI boom. So like, all the data, he wants that actually, like, whole of the global data need to convert it into insights and intelligence. And you should see to it that US dominates that, and investment as an asset class. So do you see that actually, like, next 2 years? And I hope actually, like, we still have the US rule of president not running for the third time, becoming a president, it holds on. Do you see that Trump factor is also very vital factors to look at?
I mean, we live and breathe it now, right? A day doesn't go by when we're not seeing Trump on the news. And it's like every time you think you know what he's going to do, he does something different. And he's confounding even the most astute political analyst, economist, no one can second guess what's going to be in his mind. But there is something. I think there might be some concerns in Donald Trump and the Republicans' minds of how the U.S. midterm elections go. That would explain why he's suddenly going so far and so gung ho with his attacks and threats on Venezuela, Greenland, you name it. It feels like there's an urgency there. He's also very concerned about the affordability in the USA. So he wants those oils coming into the USA cheaply because he thinks that'll lower the cost of energy in the USA. So, and he's dialed down a lot on his tariffs rhetoric. For example, a lot of the tariffs he was putting on the likes of Brazil and Colombia, those have come down because things like coffee price were too high. So those are being dialed down. So the bark we always thought that Trump's bark was louder than his bite, but he's trying to show that that's not true. Or some people used to call it the taco trade, which is Trump always chickens out. I think that's also, he's trying to say that that's no longer the case as well, that he will put action there. I think we have to continue to be prepared for the unpredictable side of his nature, and it's going to make for a very interesting couple of years. But certainly volatility is what you can expect. But for some reason, I still think the world economy is strong enough to withstand all of the volatility.
No, I totally agree with you. Every day we hear Mr. Trump, and we, as you rightly said, live and breathe what he says. And sometimes, it becomes scary because I think yesterday he talked about that Greenland is given. It's how they become part of US is only the question mark. Also, he talking about something which I think a lot of people would, I would say, take it with a lot of, I would say, volatility or the thought of markets reacting positively or adversely depending on which part of the world you are, because he suggested that actually international laws are what he says. So that was his statement. So with that, thanks a lot, Kona. It was a pleasure talking to you. And we would now like to introduce our next speaker. And we are having, in fact, you might be knowing Mr. Sood, Kona.
Yes, hello, Mr. Sood, how are you?
Mr. Sood, you are on mute, sir.
Hi, Kona, good to see you after a long time.
Thank you so much.
Perfect. So let me though actually talking about Mr. Sood or introducing him is showing sun the lamp, right? But still I'll take that and I'll do that to Mr. Sood. He's a seasoned agriculture economist and a veteran in the industry. He acts as a consultant with multiple organizations, sits on board of multiple organizations, sits on advisory boards of multiple organizations. He's having decades of experience analyzing the Indian and global sugar cycles. Known for his sharp wit and deep institutional memory, Mr. Sood specializes in the political economy of sugar. He has advised various apex bodies and corporate houses and policy advocacy and think tanks about the market cycles. In fact, he is among very few who's able to read market cycles far before many of us. His expertise lies in dissecting the friction between the populist measures, whether we talk about the FRPs, the state administrative prices, and the economic reality, which is a market surplus, making him a perfect speaker to decode the policy choices defining the 2026. Thanks a lot, Sood, for joining us and being my mentor also, right? It's always a pleasure to have you, sir.
Thank you very much.
And with that, sir, no, sir. Actually, in fact, all the learning about sugar sector and grain sector, I would say that, majority of it is because of Mr. Sood, and he has been very kind of holding my hand whenever actually I am confused. So, sir, first question to remove the confusion of a lot of our audience as well. So I'll talk about the cycle trap. So, sir, we have seen that while people like me have not seen too many cycles, but you have seen far many more cycles than us. So how do you see the 2026 surplus as a typical cyclic peak, or are we having a higher yields, or are we having a better technology or a higher acreage? Hence, fundamentally, it is breaking the tradition of these cycles of 3 to 5 years. Do you see that something which has fundamentally changed, or it is just every time we have these cycles, sir?
Actually, the sugar cycle, which was maligned by the industry, went away in 2009-10. Because by that time, the pricing formula of cane was changed. It was from a statutory minimum price, which was akin to MSP of other goods, it became fair and remunerative price, which was far higher than maybe that time 25% higher than SMP. So that gave a certain level of incentive for sugarcane area to keep growing. But just about that time came a wonder variety in north. North had been stagnant in cane yield at about 68, 69 tons a hectare, whereas Maharashtra, Karnataka, etc. were at about 80. Whereas Maharashtra, Karnataka has stagnated where they were. By the time the CO238 established itself, was about 10, 11 period. So by that time, 2013, the sugar was decontrolled because the government thought the cycle is gone. In fact, it was gone. So that being the history of sugar cycle and the cycle having stopped. Now, 2025-26 is, I won't say is a bumper crop. It may be 34, maybe 36. We'll come to that. It is just restoration of what we have seen the previous 2 years, preceding 3 years minus 1 year, which is a drought year. So, so you had sucrose production of 36 million tons. Next year was 34 point something, and next year it dropped. And so I think the comparison with the immediate past year is not on. So it was just the impact of a very severe drought. And if you see the current production of 11.8 million tons by December end, it is basically Maharashtra, Karnataka wonder. Nothing much has happened elsewhere in the country. So it's just restoring the areas where the production received a severe hit. Now, why we are finding it difficult to sell that surplus is that this is after a few years, the first year in which the global prices are subdued, as well as the Indian exports are on. Whereas from the year 22 onwards, the world wanted Indian sugar because the global prices were fairly attractive with reference to Indian prices. So the challenge is disposal of surplus. And sugar now in India has its structural surplus for a few years. I won't say forever, because we are again suffering headwinds of productivity in sugar. So Deepak, so cycle is not gone yet.
Right, sir. We live in cycles, unfortunately.
Sorry, cycle has gone. Cycle has gone. It is not cyclic change. It's just restoration of the levels which had reached in the past.
Right. So we are back to where we used to be after a little bit of a bump. Now, sir, actually, you talked about the production numbers, and that is of utmost interest. Your numbers as well, because our numbers which we have given in the introduction itself, right, was roughly around 35 million metric tons of sugar equivalent. Do you see that the number would be achieved, or do you see a little bit lower, or even further lower?
Well, my number is almost akin to ISMA's, 34 to 35.
Right.
There is a very good pull from Gur this year in Western UP. Western UP also has lower yields. Lower yields with reference to normal, not with reference to last year. Last year were also lower. But UP doesn't have the red rot disease this year as it had last year. So in totality, the UP production may be million and a half more, lower, higher than last year. Maharashtra gain about 3.5, and Tamil Nadu a bit because it has rained after many years. But rest of India about the same. So about 34.5 appears to be a good number as of today.
Perfect. So another very important pertinent question, sir. We are looking at 37 to 39 is what is the domestic prices are. And the global prices, if you take London, like $427 per ton, and so Euro plus per ton. And in such scenario, Do you think that this quota of 1.5 million metric ton, which is being given for export, it will have the same problem like last year, where we ended up like, 23% short than actually overall quota being given?
Yeah, last year's problem. Last year's problem was not the price. Last year's problem was the seller. Mills wanted a hefty premium for export over domestic prices. That was being very greedy, where you take a hit on your domestic price as well. Because if you let go of this 5%, which is allowed to be exported, your price is a function of supply demand. You're basically reducing supply. Our mills refuse to reduce supplies by asking for a premium for export, which is absolutely being greedy and foolish. This year, they're asking for a premium. First, you buy a quota for about 1,200 rupees a ton, 2,500 rupees a ton. Then you go to a mill in Maharashtra to buy, and it asks for a premium of another 1,000 rupees. So you want 2,000 rupees or 2,500 over the domestic price for export. So it's not the market being so unfavorable to you. It's you yourself not wanting to get rid of your problem. And so this year, given that the mills are greedy, given that the world market is not as good as last year, I expect 1 million tons to go out. About 93,000 tons have gone out by December end, and the destination markets are limited. They are saturated already, so they will come in for next round of purchases. So that's all. You're limited to a bit of Malaysia, uh, Sri Lanka, Afghanistan, East Africa. That's all. And some cargo in transit from Brazil is already there, which should all get sorted out this year for these destinations. So they will have some demand. 1 million tons, therefore.
Perfect. So
And
we are also
we are hearing 500,000 ton more quota to be allowed.
Mhm.
So but that will just sit as a quota.
That's the problem, that we ask for quotas and then we are not able to
No,
execute it. Then
actually, the mills should ask for open general license, in which case there will be no premium on quota, and the mills will be willing to sell at domestic price. And a year like this, probably your markets will saturate at 2 million for white sugar. And raw sugar exports, even to the domestic refineries, one doesn't see because of the hefty white premium. Because they don't have so much advantage in producing raw sugar as they lose in the premium.
So touching on the same thing, like, you talk about a little bit of greed of the industry, but industry circles are also trying to push for incentive for exports from the government. High number of production and the constraint of being able to pay the FRPs at the right time. It has been dangled as one of the reasons. Right or wrong, I don't want to get into it, but do you think that can become a possibility where the government incentivize the export of sugar, seeing that actually we are taking a serious hit when it comes to overall export? And as a country, like, your forex earning depends a lot on export. And this is where actually, like, maybe support can also come from government. Do you think that as one of the possibilities which has been talked
No,
about?
you see, WTO is there and not there. So there is that standing judgment against India, which India has said will appeal, and there's no appellate judge because the US refuses to nominate people there. So the WTO is there up to a point, but not there. However, this is against WTO regulations, Chapter 10, giving any export subsidy. And so if the government says we also don't care and give a support, uh, the heavens won't fall. But then looking at revenues of the government and looking at the fact that, like, the GST collections post reduction in rates, um, the collections are not that buoyant as they were a year ago. Against 6-7% increase, in collections. Now we have about 1% increase for the quarter October-December. And so there's a major source of revenue gone. It remains to be seen. There are other data, leading data, that industrial production is not that robust. So you have lower income tax collection perhaps. Till now they are very good. And the weakening of rupee certainly reduce the customs duty collection on imports. So where is the money? And so what is quite possible is some marginal subsidy for payment of FRP by state governments at 50 rupees a ton or 100 rupees a ton. Bihar has given 100. Karnataka has given 50 rupees. Tamil Nadu about 20 rupees. So other states might also join in and give similar amounts. And I don't expect bonanza from central government because they don't have the money. It's the expenditure. It's the expenditure department which holds the key, not the food department. And therefore it will have to be full cabinet to decide, to reconcile these things and look at competing demands for money.
Yes, I totally agree with you. In fact, I will be paying less income tax this year. My cost is paying to all these data sources, the tools which we are using, all America-based, Zoom, LinkedIn, and all that, international travels, right? And I'm seeing that, because of the substantial fall in rupee price, I'm seeing my 12 to 13% additional cost just because of currency fluctuations. And that will definitely lead to lower income tax being paid by me. So I think this is going to be a challenge for the government, that how do they ensure that the incomes of the people and especially the professionals like me, if that is going down, I'm pretty sure that it would be going for those who are I would say even in other service industry.
Absolutely.
Right. So sir, yeah, please. So now the next questions are we have been again, this is a discussion which cannot get settled, right? The relevance of FRP, sir. We all know that FRP is driven by predominantly political interest, but I'm saying that I'm still okay with the FRPs for very simple reason: it ensures that at least farmer is protected. But this new found, I would say, enthusiasm by states to be putting the state advice prices, which actually is having no logic except or I would say to please a specific type of vote bank. At the same time, also give a narrative that actually we are doing too much for the farmers. So those states like Haryana and all that, suddenly coming out with state administrative prices or to the level, which doesn't make too much of sense. How do you see that such mechanisms playing negatively on the mills? Because eventually in those states, they are creating a scenario where the mills in that state will disappear. So it's in a long term. It's not something logical. Do you think that should be do away with?
Yeah, absolutely. Because if you have a centrally determined price for cane, it's mandatory. Why put one more layer of state advised prices? But having said that, it's something not new. It may have been highlighted now. It has been there for 3-4 decades, and the industry has gone repeatedly to the court. Court has upheld that states have the power to lay down specific. So it's ultimately a political call, which between the center and the state, if they reach a discipline that will not do it. But given the politics here, wherein the central government permits rice to be procured in 3 states, Chhattisgarh, Odisha, and Madhya Pradesh, at a very hefty price compared to the MSP for rice. And just because the ruling party at center is a bit weak in those areas, although they are ruling in the state as well, but they want to keep the farmer in permanent state of bliss. And so I don't see the UP Chief Minister being advised by center not to do what he's doing in Uttarakhand, Haryana, All these are same party as center. And if they can't tell them, then how can they tell others? Now, that is one risk. There's another risk. Um, Maharashtra and Karnataka are also paying similar kind of prices because the farmers look at the environment around, they agitate. Somebody intervenes, some high-ranking politician. So they come and reach a settlement between the mills and farmers, which is about the same as. So like Karnataka is paying 355, out of which 5 rupees is paid by state, and 80 rupees harvesting and transport. So in effect, they're paying a higher price than UP. Because UP 400 includes the harvesting and transport. And in patches of Haryana, Madhya Pradesh is even more, Maharashtra is even more interesting because ultimately the taxpayer, if mill defaults, it defaults on a cooperative bank. The cooperative bank is recapitalized with the state government, and the state government taxes you more.
Right.
So it's very simple. So these states will continue to find way. So right now, 85% of sugar production is not subject to FRP. It's subject to these kind of crazy prices.
Right. Sir,
And
now coming to
I'm surprised that the industry is not highlighting it in their representations or whatever discourse they have on televisions.
so not just sugar industry, but we have seen, sir, of late, and not just even agriculture, sir. Of late, the industry associations, industry houses, industry bodies, they have also started acting as, I would say, that extension of the government itself, right? Nobody wants to put on the table something they feel government might not like it. They might try to push from right, left, and center. But when it comes to like, I'm believe me, I attend a lot of events as a speaker as well as think tanks. I'm yet to see that actually the industry people like me raise these points, right? Which I have no reason for raising it, because even if the FRP become 5,000, I don't care because I'm not associated with any industrial houses. But at the same time, actually, like the sanity, right? Of overall ecosystem to work. Now, this is where actually I bring in the consumer perspective, right? We call it consumer being pampered, right? We believe that the consumer defines how the policy in this country is being made. But at the same time, consumer is not being taken care of when it comes to, at least I would say, the sugar part of it. We are looking at the prices which are substantially high, and if you see that the inflation in the sugar has been steadily being there. How do we see that from the consumer point of view, right, going forward? Because you keep on increasing FRP, mills definitely are not going to be selling at losses. Either they'll shut down or they'll sell at a higher price in the domestic market. While we talk about MSP, but it is not mandatory that everybody has to sell around MSP or at a percentage or profit higher MSP. How do you see the consumer role playing it out? And especially like, a substantial part of sugar is being consumed through processed food, right? So my cola becomes costly, right? My savories become costly. And then actually it goes in like, 10 gram, 5 gram packet. I won't even be able to know that actually like, I'm getting a hit, my pocket is being cut. And it is happening. And then I end up paying more GST to the government on that. So actually, if you see that for a product like or commodity like sugar, it is not that 100% like, all the sugar coming in my house is through like, it comes 40% in different other products. And then I'm paying more eventually. And which doesn't like get reflected in like, the news article. So how do you see the consumer side? Even he is suffering, sir.
Well, I would say the consumer is not suffering. The reason is supply demand determines the price and not my cost. In the long term, my cost because I go out of business. But in the medium term, short term, um, the mills may be forced to sell at marginal cost. In case of sugar, not even that because I'm obliged to crush even the last cane standing in the field because there are other issues, the local laws and the farmer pressure and state pressure and so on. So I'll have to crush every stick and I'll have to sell below marginal cost if I have to. And MSP, well, the industry would have very good reasons why they are seeking a revision. But I think long ago, even in my high school, I learned that demand supply diagram. One curve dropping with the increase in price supply, which is the demand. Another curve increase in price, which is the production. And the intersection is the price which the market determines. I have lived through control years. Nothing ever sold at control price. It sold above. So I wonder why MSP will you respect it at all. If it is 42, if supply demand equation indicates 38, it will sell at 38. Nobody can stop it. Because then what do? You carry stocks, you want to sell at 4200, you carry stocks. And you carry stocks, then you start wondering that in 1 year's storage, I lose 4,200 rupees. And so you will better discount that storage cost and sell it today. So the reason is it is sugar industry is now structurally surplus for at least 7-8 years, and some way has to found to reduce supplies, and that way is exports. Industries not wanting to export in this quota regime because of being greedy. The demand, well, they're saying it is reducing, but the numbers don't say so. The demand is growing at about 1.5%. And ethanol, um, well, they are unable to become a large player um, for a simple reason that most of the ethanol is concentrated in Maharashtra, Karnataka. And, and therefore, not much sucrose can be diverted there with growing demand in the country. Because what do? You grow in one part of the country, carry it all over in diesel lorries, and you say you are saving environment. Rather than that, you will pick up from a distillery, which may be grain distillery next to the IOC depot. That is a ground reality. Now, if capacity is mostly in these two states, the demand will be also mostly in these two states. For instance, out of sucrose diversion, most of the diversion is from Maharashtra, Karnataka this year. And the oil companies will buy only what they need in nearby areas. So the industry is faced with seasonality because the ethanol is required 12 months in a year. They can produce only for part of the year. And it is excessive concentration in one place. And considering both these are problems which I don't think there's a solution, currently about 4 million tons is the max possibly which can be absorbed. Going forward, with increasing about 6-7%, which is a growth in gasoline consumption. So it's not the only way to generate demand is export. They should be willing even to discount on domestic prices, leave alone CK premium. And they should ask for OGL.
Right. Totally agree with you. Thanks a lot, Sood. It is always a pleasure to engage and learn from you. Right. And thank you for correcting me that the consumer is getting not ill-treated, because that is sometimes like, when we see the numbers. Because, sir, when I go to Blinkit and I see 58 rupees for no sulfur sugar, right, per kg, it gives you indication that maybe like, I may be paying more, because then I compare it with MSP and I say that, hey, I'm paying 18 to 20 rupees more than the MSP. But yes, that I'm saying that's a part of the game. Thanks a lot, sir. Now I would like to move to another of stalwart of the industry, and we are having Mr. Sacheti, and it's a pleasure to have you, sir. Thanks a lot for agreeing to join this discussion. So I would just give a background about Mr. Sanjay Sacheti ji. He's a country head for Olam Agri in India. As a global leader in food and agri businesses, he is having a decades of experience in supply chain management and commodities trading. He oversees Olam's extensive multi-commodity footprint, including sugar. He's an expert in managing global supply chains, navigating the complexities of logistic, hedging, and cross-border trade flows. His perspective is vital for understanding how multinational trading houses like Olam are positioning themselves in 2026, moving from simple bulk trading to value-added products. Sustainability, traceability of supply chain also adds an interesting dimension to it. Thanks a lot, sir, for joining us.
Thank you, and good afternoon to everybody. Thank you again, Deepak, for inviting me to this session. Pleasure to be here.
No, sir, thanks a lot. Really appreciate, because the type of deep understanding you're having of the sector, it would be of enormous value to definitely our audience and me for sure. So, sir, I just straight away get into the first very important vital question. Sir, the strategic hedging, right? In a surplus year with a decent export allocation, are you seeing a shift where we actually, Indian millers, as Sutsa were talking about, like looking at the exports market more than just trying to get into the domestic market and liquidate what they are having? Or at the same time, also, are we looking at any hedging strategies? Because the global market has also been volatile. We have seen 25% prices are getting washed off over a year. And currently we are just about a notch above the global lows, which we saw in typically December. So how do you see it going forward, sir?
See, Deepak, I have seen some changes in the attitudes of the millers. The more evolved millers, the larger groups, they have been a little bit more proactive, given the policy constraints and the kind of framework we have for exports today. The more evolved groups have been more proactive, and they've tried to hedge to the extent the quota regime allows them to do that. But the larger group of millers, no, I don't see them acting very proactively there and trying to hedge. But having said that, I think the quota regime is definitely an inhibitor, and what Shree Sood Saab said, I think the industry should be demanding a quick move towards the OGL regime, where exports are completely free and you don't have to be hamstrung by the quota-related restrictions, because that acts as a barrier to full hedgeability. So if suppose I have a particular long position which I have built in, which is fairly large and disproportionate to the quota which is available, it is very difficult to hedge. How do I hedge? The quota available is a very small part of my total production. It's only 5%. So how do I hedge? So hedging is minimal today, and very few groups have the wherewithal to go and directly hedge on international exchanges. That's very cumbersome. It requires different kind of capabilities and skills.
Right. Sir, you rightly mentioned about OGL and what Sutsa were also talking about. And again, not naming organization, but in some of the session I've done previously and also Sugar, the associations will agree to join, and then they would ask what type of questions you'll be putting across. And as soon as they'll see the question and they see this part of it, right, then they take a back seat and they generally get some important meeting has come in. So Deepak, my apologies. I'll have to excuse myself. So I've seen that actually happening, that within sending the question within, let's say, 2 hours, 3 hours, 5 hours, eventually some meeting will come in. But sir, actually, how do we ensure? Because see, with this quota system, we are restricting the overall industries in a very bad manner. Just like you have said, once you have capability, or a Renuka Sugar is having a capability, the companies which are having capability, even they get seriously constrained, because they cannot create the risk mitigation possibilities because of this quota. So how strong do you think that industry needs it, and especially organized player needs it?
Given the observation which Sood Saab made, that we are structurally in a surplus situation, see, there is no other way but to what we need to do is to ensure that the most competitive mills and the milling and the cane growing areas remain in business, and the rest go out. By creating this quota restriction, what we are doing is that we are creating a distortion. We are creating a cross subsidization structure within the industry. And obviously, there are vested interest groups which like this, and people like us who, after a very careful evaluation, let's say a few years back, decided that the best area in India to be into sugar milling is Maharashtra. because of the agroclimatic conditions, because of the inherent competitiveness, because of the export-related, synergies which are there. We feel completely at a loss when this kind of a quota regime is introduced. I will talk about, let's say, the scenario 3 or 4 years back when it was under OGL, I think 2022 or 21. And by June, I had completely, swept my godowns clean in June of the year, 3 months after the end of the crushing season. And that was the best season which I ever had. But it was purely on the basis of my competitiveness, right? And I would have been a very competitive miller, but now I'm forced to carry it just because of the quota regime. Otherwise, large groups in Karnataka and Maharashtra would just completely sell and they would be naturally competitive there. And that is in the best interest of the Indian milling industry.
So just not Indian milling industry, it is in the best of interest for, I would say, even as a country. See, there is why would be giving a quota to someone sitting all the way in Uttar Pradesh or hinterlands of Haryana, where the cost does not justify them to be looking at export. But at the same time, then because they have that quota, that they restrict the people who are having capability and I would say economic viability to export. So actually, we are creating a negative environment where, you don't want to be competitive. You just want, that let us go with the game and maybe make money out of my quotas rather than actually being competitive to export.
Absolutely. So industry dynamics are such that these kind of policies are propagated.
Perfect. So we are pushing for the change in the mindset. I am not very sure how and when we'll be successful, but we'll keep on doing that. So let's talk about a little bit of the logistic bottlenecks. We often talk about productivity and efficiency, which is very important. But are you seeing even the constraint when actually we are exporting sugar for global markets? Right, our logistic bottlenecks as well, whether it is actually the domestic logistics or as well the logistic at the port. We have seen that the processes are not as smooth as in some of the markets. For example, Brazil, right? The logistic moves so well, like from Mato Grosso to all the way to the ports and from port to getting shipped, right? Those, in fact, they are more, Amazon is most difficult than in Indian, I would say the infrastructure here. Do you see that infrastructure challenges are also there, which are creating additional costs for us? Availability of rake or everything going through land transportation, which adds up the prices?
Deepak, I would keep the perspective of the last 10 years or 15 years perspective there. I think we have improved a lot. The road infrastructure, the port infrastructure, the port turnaround times, the kind of ships which are able to come in, the new ports which have come up, let's say a Karwar or a Jaigarh or even Goa to a certain extent. I'm just talking about ports which are within the close proximity of my mill. I think a lot has improved. And while we can still improve the port turnaround times a bit more, but I think the inland logistics have become better. What can still become better is, I think the movement by rail. But
Exactly.
because most of the mills are in the hinterland, typically it is always a 3P kind of a logistics which is required: road, rail, and then again road. So that becomes very expensive, and sugar is a slightly delicate commodity from that point of view. So it leads to losses also when multiple handlings are involved. So that part, I think the rail network can be better, and that is something which is a very long-term thing. But India otherwise has become competitive. I visited Brazil a couple of years back, and I had, that was with a sugar industry delegation. I would beg to differ a little bit. I think the inland logistics are not efficient. Brazil is even a larger country. Mato Grosso, okay, we can talk about that, but sugar industry goes much beyond that also. And inland logistics are not good. They don't have the best of rail network. It is concentrated in a few states, but overall, I think we might be more efficient than Brazil in many ways.
Fair
Because
enough, sir.
they find it difficult from upcountry mills to the port. I think the turnaround times are very long there, and they have quite a few challenges. You leave aside the southeast there, the other parts are challenged.
The perfectly point taken, sir. I totally agree with you that there is an improvement, and the real I was what I was talking about. That actually, I think we can do a little bit more in ensuring that, like, we don't have three Ps. Actually, we are able to transit directly, maybe closest from our mills, like using railroad to like some of our ports. And so that brings me to another very important, pertinent point. Being a miller, so this diversion or like talk about ethanol. We have seen that government started with the intention of having 50% diversion from grains and 50% from sugarcane base, whether it is syrup or whether it's molasses. Then actually, like, we saw that suddenly the shift was there. And in fact, like, initially, as you would have seen the data that 70% of the ethanol production was from typically like, the sugarcane based activities. And in fact, the initial document, if you read that, the reason for coming out with the policy of blending way back in, I would say the previous regime, it was like, ensuring that the cane farmers are paid money. This is one of a great possibility. But of late, we have seen that, like, this year, the sugarcane industry has been literally shut out, right? Even with a good production, with hardly like, 28 odd percent allocation of ethanol. Do you see that actually we also need a very clear policy on that, that what percentage actually government looks at grains and sugar, not for today, like next 10 years, next 15 years, so that people can plan accordingly?
Absolutely, it requires very long-term thinking actually, because the kind of changes which this policy, the ethanol policy, has brought about over the last 7-8 years have been pretty profound, and the agricultural and the processing landscape has changed significantly. So, and where we stand today, clearly some of the issues were not anticipated, and the whole impact on vehicles, the ethanol blending on the vehicles, their life of engine parts, and how the consumer would perceive a lack of incentive to go for blended petrol. I think those issues were not really anticipated. If we need to go the Brazil way, I think those issues need to be sorted out, and all stakeholders, consumer, auto industry, petroleum industry, everybody has to be taken into account, and a very long-term policy which balances stakeholder interests has to be in place. So typically, we have to answer what is there in it for the petroleum industry. They would say that, look, we are quite happy selling 100% petrol. Why should we go for blended petrol when crude is likely to go towards $50, or maybe if US were to have their way, maybe lower than that. The auto industry also obviously has to make substantial investments, and they are also answering this question. They are also asking this question as to what is in it for them. And more importantly, I think the largest lobby, which is the consumers. So we need very long-term policies which takes into account the interest of all these stakeholders there.
No, I totally agree on that part. Like, overall, we have to think it as like, a collaborative effort from the automobile industry, the, I would say, ethanol industry, which includes both grain and sugar-based industry, as well as for sure government. Now, coming to another point, sir, actually, like, the government policies, whenever we are talking about in global forums, like, the Indian domestic policy has always come under scrutiny of being having a short-sightedness. Do you see that actually, like, as a global player, for you, it becomes a little bit of difficulty when actually, like, we have to also factor in sudden changes in the policy in your risk mitigation strategy, and how you're handling such type of scenarios where, like, you have, for example, Sood sub said that maybe 500,000 would be added to, like, your export quota. We started with 1.5, the ask was for 2.5. So there is a lot of, I would say, uncertainty rather than like clarity, because in fact you would like it at the start of the season itself, you have a complete clarity that what's going to be happening, right? Rather than actually, like, just wait and watch what's going to unfold. How do you see, like, as a global corporate, right, trying to, I would say, move around with such scenarios, sir?
Yeah. So, Deepak, I would just take a couple of additional minutes to answer this question, because
Please,
there are
please,
large
please, sir.
issues involved here.
Please, sir.
Today, if you look at the Indian agri landscape, just being a trader is not sufficient. You need to do much more. And when we we took a lot sector, we found that just being, a logistics and trade player will not give us sufficient headroom for growth. And that's why when we looked at multiple commodity value chains, we found that sugar was one sector where the headroom for growth by way of, multiple revenue streams being there, and the way the ethanol sector was positioned, we found that the headroom for growth was very high. But yes, the sector was, quite susceptible to government policy related steps. So we took a conscious call and we said that we need to get into richer business models which are more value addition oriented, which are more consumer oriented. So it was a conscious call. However, the government policy part will always be impacting this kind of a sector. So while there was a strategic imperative, we were conscious that this would impact us. And the way we have looked at it is that your manufacturing and the product configuration has to be as diverse as possible. And you have to be into as many value-added products. So you need not be only in ethanol. You need to probably get into ENA, and into value-added ethanol products. Similarly, sugar has to be not only plantation white sugar. It has to be more refined and institutional sugar, which is more preferred by processors and other institutional buyers. Similarly, enriching your manufacturing configuration by getting into CBG or into CO2 or other kind of downstream products is something which is a clear imperative. So this is not a trading business. This business cannot survive only with a simpler business model. It has to be enriched with value-added products and a manufacturing configuration which allows you to overcome the government policy-related limitations. So that's the way we are looking at it, and that's the way we would develop the business as we go along.
Sorry to take a little bit of liberty because you touched a very important point. Sir, in fact, not just sugar, if we see that Indian mindset, right, even if the large organizations, apologies for saying that, have been initially to be looking the market as a trader, whether we look at pulses, whether we look at grain. Now, eventually, we are seeing with all the, I've said that blessing in the disguise, knee-jerk reactions by some of time the governments, that people are looking at a wider value addition game. But again, that game has not been perfected. And this is where, again, we try to get the traders to try to be value adders, right? Rather than themselves having. So if you see, I engage with traders day in and day out. Now, they don't even have a mindset of the value addition game, unlike what we see in typically West. But we are trying to, with the same people, same ecosystem, trying to create a value addition based environment. And when we talk about value addition, we are having a separate, players in the market which try to just play the value addition game. They don't get into the commodity game. How are you looking at bridging this divide? Because eventually, I think agriculture commodities, it is gonna be from farm to the fork, right? That game only is gonna be giving you the value both as a consumers, right, as a producers, as well as those intermediaries, which are companies like Olam. How do you see going forward next 5 years, 10 years for the overall ecosystem and the professionals? Where we see that we become a strong value proposer rather than just a commodity player.
So Deepak, the days of compartmentalization of the value chain are over. This is the years to come are the years for value chain aggregators. And I'll give you only 3 examples, and all of them have played out in our lifetime, right? I'll give you 3 examples in India: Adani Wilmar, an ITC, and Tata Tea. Whenever I look at players, and then let's look at on a limited scale Shree Renuka Sugar. All these players, if you look at it, they are end-to-end players. They were all commodity players a few years or a few decades back. Tata Tea was a plantation company. Over a period of time, they realized that just by being a plantation company, they don't have control over the market. And they expanded, they became a consumer company with very strong back-end linkages. ITC was a wheat trader to start with in the very initial stages, and ultimately they have become a processed food powerhouse. And that's a conscious call which they have done. And I've, I'm sure you have also tracked it since, let's say, mid 1990s to late 1990s till now. For 15 to 20 years, I can safely say, and nobody has told me so, and I'm sure they invested in losses. Similarly, you look at Adani Wilmar, the JV came into being sometime in 1998, 1999. The partners must have been at loggerheads. They wouldn't have had a complete alignment on how to run the business. For 15, 20 years, again, they invested in losses. But all these three companies are now hugely profitable companies with such a strong strategic positioning that the number two or number three player has no hope in hell to immediately dislodge them. And you look at Shree Renuka Sugar and just look at their sugar strategy. They are a sugar trader, they are a sugar miller, they are a sugar converter, so by way of their port side refineries. What they've done is that they've completely straddled the complete value chain. And sometimes some part of the value chain would be valuable for you, sometimes something else. So that's how you de-risk yourself from market cycles, and you are able to bring on the table multiple sources of value, which makes for a very robust and resilient business model. And that's the way to go. And that's where, a Balrampur Chini or a DCM Shriram or a Dalmia would any day beat an international trader. Because international trader, sometimes the business is there, sometimes it is not there. And in any case, these companies are actually nibbling at your space. They have become exporters. They have linked up with the destination players, and they are now reducing the space for pure play traders. So the writing is very clearly on the wall. You ought to be a value chain aggregator there.
But so do you think that people are seeing the writing on the wall? Because it is very much evident that this is and these are successful models in India. And I'm having a huge regard for ITC, and luckily, with the top management, I have been on and off engaging and learning from the work they have been doing. And in fact, one of the most respected company from my side, as you rightly said, investing in the losses. If you see their balance sheet, they were pretty difficult times. And leaders like Siva Kumar, leaders like the current Mr. Puri and all that, they've put that I would say the neck out and say that, okay, fine, slaughter it in case it doesn't go right. And not luckily, I would say with the right effort, it has gone up. Do you see even other companies following that track, or actually if those who don't follow that track, as you rightly said, that will getting wiped off eventually? And so one more thing, these companies, if you see, they dovetail back to the producers as well. Right. ITC gave a humongous value, right? In some of the initiatives, successful and failure, both has happened, whether it is e-Chopal and all that. They've tried to be with the farmer, trying to help them be more sustainable, more financially viable. Similarly, when we talk about Tata Tea, or when we talk about even the Renuka Sugar, they do a lot of on-ground activities with the farmer, and in ensuring that actually their feedstock, right, it is not stuck, because the loyalty and the I would say the relationship connect with the producer is there. So even you see that is also very important, that reaching out to the farmers, working with them as well.
Oh, hugely beneficial, because there is so much of value, shared value, which has to be created. And don't think, pardon me if I'm using some very cliched terms there, but we know that it's a broken value chain. Agriculture is a broken value chain. There is huge, potential for generation of incremental value there. You have to look at the China model. You have to look at certain other models where, when these value chains have been effectively integrated, and I would use the word effectively integrated through whichever model, it could be partnerships or it could be land ownership oriented, whichever way. But these models have created tremendous value. And you look at the sugarcane, right? The sugarcane value chain, just because the farmer and the miller are joined at the hip, tremendous value creation for the farmers. I think good value creation for the millers as well. And obviously, the government policies also have helped. So I am seeing that in Olam. I think our motto is very clear. We are a farm to fork company. We want to straddle the entire value chain. And we were very conscious that we are in a very thin margin business. And unless and until we aggregate margins across multiple value chain steps, our earnings expectations, absolute earning expectations, and the rate of earning expectations cannot be met. So this is something which Olam is doing. Cargill did it. In India, they did it in a different way. In US, they are doing in a different way. You look at ADM with their, with their investments in food ingredient companies like Wild. They have made those kind of investments. You look at Bunge in India. Bunge in India is not a commodity company. They are a value-added products company. You look at Dreyfus today. Dreyfus, the classical trading company, is now talking in terms of brands and distribution and processing. Maybe early days for them, and maybe it's a pilot for them globally. But they are realizing that there is no business unless and until they do this. And allow me to again reiterate this term, value chain aggregation. This value chain aggregation. I will also give you an example today. Today morning I spent time with the science of a central Indian commodity trading house, commodity processing and trading house. They are very classical, rural India-based large commodity processing house. They process cotton, they process sugar, cane, and they process wheat. Today, those science, and they are all MBAs from reputed institutes globally. They had come to meet me just to say that, look, how do we go beyond what we are doing today? And the idea about value-added, differentiated, product-oriented business model, that resonated with them, because what their earlier generation is doing is so 1970s and 80s. And they know that that is where from time to time the space keeps shrinking. And the boy next door or the guy next door is able to compete with them as much as effectively as they themselves are doing, because it's very undifferentiated, it is very commoditized. So that realization in the minds of the science of this of the industry in traditional business houses is also there, that they need to move into that kind of a space. So it is in large corporates, and I've talked about Indian corporates, and I've talked about very traditional family-oriented Indian businesses.
Right. So now coming to the last part of the discussion, so sustainability. We know that sustainability has been something, right? Has been talked a lot about when it comes to industry like sugarcane. There have been a lot of talk about the usage of water in this industry. Generally, we have got that I would say discussion sorted out a little bit, because there was a report by Indian Institute of Sugar Research which talk about sugarcane is not water gulping, but at the same time we know the sugar processing itself is having a heavy footprint of water. At the same time, now the consumers, I would say evolved consumers, are also looking at where the sustainability becomes part of the matrix. And this is where I would request your indulgence, that how do you see the sustainability and that aspect, whether we see it as a strong marketing push, whether we see it as a compliance push, or whether we see it just being good at heart as in corporate, sir?
So there are good to do things and must to do things. I would say as long as this continues to be a broken supply chain where the farmer is on his own, and the rest of the industry or value chain are on their own, sustainability is not really critical. But again, I'll go back to the sugar industry, where it is a very integrated value chain. It is a must to do thing, because today I can tell you that to run my sugar mill, I get water from a few kilometers away. I've got an underground pipeline which is running a few kilometers, and I'm drawing water from there. And whenever the rainfall is short, I'm seeing that the local farmers and the local villagemen become very uncomfortable that water which otherwise would have gone into the fields is being drawn by me, right? So I'm just giving you a must to do thing. But in my rice operations, I should be worried if I were to have close connect with the farms. But because I don't have close connect with the farms, it's a good to do thing. Because if there is a problem with water, I'll go from farmer A or farm A to farm B, or from zone A to zone B. It doesn't matter to me. I'm not bothered. But if I were to be very integrated with them, if the value chain integration were to happen, and I am joined at the hip with the farmers, and I am running a farmer program, helping create that value, and when I talked about that mutual value, if that kind of a business model is there, I would be very mighty worried about it. And that is where sustainability becomes a very important one. You go back to the Sahyadri business model, right? You are very familiar with what Vilas Shinde does there, and the way it's a very integrated business model. sustainability is absolutely a must-to-do thing there because you are integrated with the farm. You should be worried about what is happening at the farm. But if you are a distant player and if you are an opportunistic, player in the industry, just like a trader is, heavens may care. I move from farm A to farm B, zone A to zone B, country A to country B. It doesn't matter.
True. No, so I think we need to have people which are today itself, like, I was talking to my son and we had some discussion. So he was talking about, like, somebody praised him that you are the sharpest mind in the class. And he was so happy, though I didn't want to discourage him. I gave him a lesson. I said, today's world doesn't need the sharpest mind in the class. Today needs someone who is having a broader heart and stronger spine than just sharpest mind, because the world is changed. We are having AI, we are having technology, which can take care of, like, a lot of your intellect, right? But actually we have to become more human than the humans, right? To see to it that actually AI is not able to replace at least us as an individual. And as you rightly said, corporates would also have to start thinking in those direction. And sir, I totally agree with you. Like, the traders need to be very careful. Their role is shrinking, right? Their activities, if it is not adding value, right? They cannot just live in where actually connecting to people and making money out of it, right? That is passé. The world has moved beyond that, and eventually the technology is gonna do that, all of it, right? You don't need to have traders should be doing that. So until and unless they start reorienting themselves, I think it would be a challenge. Maybe it is a smaller challenge. They still have time to change, but maybe 5 years, 6 years down the line, they might not even have the road to run. Runway will end, and they might end up crashing. With that, thanks a lot, Sanjay ji. Like, do you want to have any parting views for people who are in leadership like you, that actually, like, 2 or 3 points which they should look at going forward, sir?
I think I'm more concerned about a couple of things. One is the availability of talent and the ability of this industry, the agri business industry, to attract top talent. I think that is one area, and leaders should look at that. How do we attract the best talent? How do we make this industry a very aspiring, aspirational place to work? What I've seen over the last 20 years is that the quality of talent which this industry is attracting is going down. The early 90s, when India started opening its doors and the agri trade started getting liberalized, we saw good quality talent coming in for at least the first 15 years. But that part has changed. And I would like it to be, with AI, with agri-tech, with a kind of new business models which are coming in. I would like it to be a place where we can attract the best talent.
Right. No, sir, I think the talent is two-way street, right? The unfortunate reality is that, sir, it is what I said, the human values. Sir, current lot of talent is very smart, but they have become very transactional in agriculture. And that leads to even the people who they lead, right? They also ending up being transactional, and then it creates a vicious cycle. I think the industry can come out of that vicious cycle. And I've been providing training to some of these players. And believe me, like, the first thing which I'm able to see in the middle management is that the stress of managing my P&L. And there actually, like, the day starts with, like, P&L and ends there, rather than put application of mind. And so that is what they try to declutter them, that actually, like, if you take the right step, right activities and right thought process, eventually the result will change, which will also impact in P&L. And thanks a lot, sir. And it's a pleasure to have you and have this extremely interesting and insightful discussion. Looking forward to have many more. Thank you, sir.
Thank you so much. Pleasure and a privilege for me. Thank you.
My pleasure, sir. My pleasure. So now we move to our next speaker, and from the global point of view to Indian point of view to how top mills are running their business and impact of policies. Let's go a little bit on to the destinations or the market sides, and let's look at Africa. Again, I believe Africa is one of the biggest opportunity the mankind is having today. And Africa is a beautiful continent which is having humongous amount of natural resources for agriculture, whether it is about the land they are having, whether it is about the availability of water, and whether it is about great talent they are having. And to talk about Africa, we are having Mr. Willis Agwingi. He's head of research at Kulea, and he is working in Kulea, which is a market intelligence firm focused on African agriculture markets. He brings a crucial destination market perspective on the table. While the world focuses on Brazil and India, yes, they are surely big markets and big producers. Willis track the consumption patterns, deficit gaps, and import flows in the African continent. He's an expert in African demand story, analyzing how urbanization, current fluctuation, and African continental free trade agreement or free AFCFTA are reshaping the continent's role from a passive importer to strategic trade partner. Welcome, Willis. And in fact, I'm literally in love with your continent. I've been tracking Africa for a long time, a regular visitor to places like Tanzania, to Congo, to Nigeria, all difficult places. And I love what Africa can offer. With that, floor to you. I think you are having a presentation you wanted to share, and then we can take it forward from there.
Yeah, Deepak, thank you for the introduction. Let me see if I can put through the presentation so I can share.
So you'll be having a beautiful button saying share at the bottom of your window.
Yeah, I've seen it. I'm just starting.
In fact, while Willis shares, actually, I would also like to appreciate the beautiful city he's in. I think if he's in Nairobi, it's always naturally air-conditioned city, a beautiful city, and it's always a pleasure to be there. Yeah, perfect. Over to you, Willis.
Thank you, Deepak, for the introduction, and good evening, everyone. I believe it's already late there. I'm Willis Agwingi from Kulea. At Kulea, we deal with market consultancy. We do agri-feasibility studies, and we also do brokerage to this part of the world. So we're asking ourselves today about the future of the African demand, whether production is increasing or not, what the outlook for imports in 2026 versus the years we've seen. So I prepared a short presentation. So at Kulea, we track the flows and also the investment in the industry, especially in Eastern and Southern Africa. So on the right-hand side is a map of the mills in Africa, and as you can see, it shows you clearly where the investment is coming, where there's dense concentration of factories, and where there's very little coming up. So most of the production usually happens in Eastern and Southern Africa. There's bit in North Africa, in Egypt, and places like Morocco a little bit, but most of it is refineries in that region, and then the rest is basically purely imports. On the left-hand side is just how complicated Africa trades. So those are the flow lines. So Africa trades with most of the world's producers, including Brazil, the Caribbean countries, India, and other Middle East refineries. So we're able to track all this. So in matters of self-sufficiency, because we've seen several African countries launching sugar master plans, others building on what they have, others becoming very ambitious on what they should do. Indeed, it's a continent with massive potential, lots of arable land. And we believe with good management, we can achieve sufficiency. But in most cases, we have not been able to rebalance between putting up mills and also growing the cane to be able to support the dream. So here's a picture of what's happening, is starting with the Horn of Africa, East Africa. And when we talk about the Horn, is about the area around Sudan, Somalia, Djibouti, Ethiopia, that parcel. So in that area, we are seeing more of imports because of the current situation, especially in Sudan and Ethiopia, with the political instability. Ethiopia had a conflict in 2023. Sudan started in 2024. Ethiopia now is okay. Everything is back to normal, but still with the heightened tension, especially after the government indicated that there's a possibility they could invade Eritrea. So that is a real issue. Generally, the output in this part of the region is dropping. We've seen quite a huge drop in Sudan and Ethiopia. because of the disruption. In Sudan, only a section of the factories are working. The irrigation systems are not running properly because of the disruptions of power infrastructure. But as you move towards the southern part, that is, as you move southwards to East Africa, it's all booming. We've seen lots of investment in places like Kenya, Uganda, and Tanzania. This is like now becoming the hub of sugar investment. Lots of mills coming up, milling projects, those that are under construction. And generally, production is rising. If you look at the chart on the right, so the green bar is the production. We are still way below what is expected of us as a region, but it's rising, except it's still so much dependent on rain-fed agriculture, and therefore there are time-to-time disruptions that are causing the deficit to grow in some years than others. But the general trend is that it's increasing. So despite the rise, the region is also rising fast in terms of population growth, with about 2 to 3% annual growth in each of the countries, on average about 3% in East Africa. So we need to do more in terms of investment, especially in cane development. Now there are mills, the install capacity is huge, but there's not enough cane to keep it all running, especially in Kenya and Uganda. There's little growth in Rwanda, Burundi, nothing in South Sudan, so those areas will still depend mostly on imports. Then on Southern Africa, we haven't seen any new milling projects. The last activity that was there was basically mothballing of factories in South Africa. So 2 factories were mothballed, I think, in 2022-2023 season. Since then, one of the largest milling groups, Tongaat, has exchanged hands. It went into business rescue, but it's now back fully operational, and all is going well. So it's fairly stable in Southern Africa. The area is not growing as much. And so we expect that South Africa will still retain its surplus position, but the surplus is diminishing, especially because of, again, of the rising population. It's not growing as fast as what we've seen in East Africa. It's basically about 1% change every year, but still that is diminishing the surplus position of this region. West and North Africa are not prominent for sugar production, except for Egypt, which, as I must mention, is a big producer of both beet and cane sugar. But the rest of the regions are mainly run by refineries in the north. That's Algeria, Nigeria, in places like Tunisia, Morocco. Nigeria is doing a bit of cane production, but it's like a drop in the ocean. Very big plans, but yet to be actualized. So off the back of this, I was looking at also the Indian connection. And if you look at the Sanjay diagram on the right, that is directly from our Kulea app, you can see just how big India is as a partner, as a trade partner to the Atlantic coast of the Indian coast of Africa. So Brazil is still present, but mainly serves the Atlantic coast. So the countries in the West Africa and in the southwest of Africa, and the refineries in the north. But if you look at the Indian Ocean coast of Africa, it's mainly Indian sugar when it's available. And when it's not, then there's a switch to whatever is available, either from the refineries in the Middle East or from Thailand or Brazil. But this is mainly a region where India always dominates. And why is Indian sugar so preferred? First is because of the proximity. It's faster to get sugar from India than if you are to buy from Brazil. We've had periods where sugar would take like 4 months. Transit from Brazil to, say, Somalia, places like Somalia, Djibouti. But for Indian sugar, 14, 20 days, you have the sugar in the port, you can clear it. Also, the packaging in terms of container stuffing. Indians are doing 27 tons per container. In Brazil, it's still 26. It used to be 25 before. So we've seen this kind of improvement in COMESA, also in COMESA partner countries. They're still not able to achieve 27 tons per container stuffing. So this makes Indian sugar still preferred in this region. So despite the growth, especially in East Africa, we still hold our position that there will still be gaps. There will still be gaps that will need filling, and this would mainly offer position for Indian sugar to come in. Also, the gap is widening in the Horn of Africa, in places like Somalia, Ethiopia, Djibouti. Ethiopia's population is bulging. A few years ago, there were 113 million people. Today, it's well over 120 million. And still, if you look at the per capita demand, there's still lots of room to grow because it's way below the world average. People are still consuming about 8 to 10 kgs per capita of sugar. So as the living standards improve, we expect this region to take more and more sugar. The facilities there, especially in Ethiopia, there's no factories in Somalia or Djibouti, but in Ethiopia we have huge installed capacity, but little to no cane in most places. And it looks like they're not going to achieve what was desired because production is implicitly falling despite the rising demand. So this is an area that will offer a very good market for the Indian sugar. Also, with the war in Sudan still continuing, we've seen a drop in the imports into Sudan. But as that happens, Libya's opened up. Initially, we used to have sugar getting into Sudan and some of it filtering across into Central Africa, into places like Chad, Mali, a little bit into Central African Republic, into Niger. Now that is taken over by the Libyans. They're doing great in that and supplying that route also because of the ease of transportation in that country, very low fuel cost. So this is where India will still find enough ground if you guys keep exporting. I know it's now very tightly controlled in terms of the quotas. So over the past 2 years, that is 2024 and 2025, currency has also been a big issue, especially because most of African countries are still heavily dependent on dollar, the US dollar. And generally for international trade, you need US dollars. So we've seen certain countries suffering more than others, especially countries like Ethiopia. The Ethiopian birr has been one of the worst performing currencies in 2025. It's expected to continue losing against the dollar until perhaps mid-year. I know the government is already negotiating with Eurobond holders to try to reclaim what is lost. But it's not looking good because it takes like about 2 weeks to get US dollars from the banks, the commercial banks. And so it's pushing most of the traders to go for the black market. And in the black forex market, you're getting it at a significantly higher rate than the official bank rate. So the official bank rate today is about 165 birr to the dollar, while in the black market, they are selling it at between 183 to 186 birr per US dollar. So that has been a real issue. That at times causes stockpiles in Djibouti because you find there is demand, but the traders cannot pay for the sugar and therefore stocks are just growing in Djibouti port. Sudan has also struggled, especially at the beginning of the war. But today, traders have devised ways to be able to manage it better. We are seeing increasingly more ease to pay for commodities, especially given that some of the companies now have overseas offices in places like Dubai, so that is enabling trade to carry on. In places like Ghana, which struggled before, the Kenyan shilling also had a very rough time in 2023, 24, and also the Nigerian Naira. But in 2025, we saw a bit of stability in these countries, which is enabling trade to carry on smoothly. Other countries that I also wanted to highlight are Burundi. Burundi is a small African country in terms of size, but usually struggles a lot with dollar liquidity. At times, even causing massive shortages in the country when traders are not able to pay for commodities because it depends so much on imported commodities like sugar. So the other thing that I wanted to look at is the consumption shift, and really the African industry has fared much better since COVID. there was quite a shakeup during COVID, like in other places. But since then, we are seeing consistent growth in most places and recoveries all across the continent. But as I mentioned, the East and the Horn of Africa are the places where consumption is rising fast at about 2.5 to 3%. In Southern Africa, it's a bit low at 1%. But generally, the areas around the continent are getting better. So we are not seeing any consumption shocks in any of the countries. Perhaps what I would want to mention is the shift that we've seen in and around the Horn of Africa, at around in Somalia, Djibouti, and Ethiopia. So these are countries that predominantly are white sugar markets, so they would go for Indian 150s when it's available. But last year, 2025, we saw quite a massive shift towards refined sugar because that was what was increasingly available. There was, yes, 150s from Brazil, but it was taking too long. And therefore, these markets have increasingly shifted towards buying from the refineries in India and the Middle East. But when Indian sugar is available, this is, again, a place that India would make lots of sales this coming year. So, thank you. I just had it very brief to leave room for discussion. For more information, you can reach the Kulea team at the given contacts, and we'll be happy to help.
Thanks a lot, Willie. Pleasure. It's a great presentation. Thanks a lot for all this. Now, coming to very important and pertinent question, right? We saw that, as you rightly mentioned, there is a 3% demand year on increasing in Africa. At the same time, there were a good period when actually production, especially in East Africa, was going up. Then suddenly we saw a bump, and then actually the recovery has not been there, especially when we talk about 2023-24 onwards. That was a bad year. And in fact, last year was also not that great. This year, we are again seeing a little bit of dip. So what according to you, while every possible government is talking about self-sufficiency and coming with the plans, right, what they call, I would say that great manner, the master plans, right, the sugar master plans, right, why still we are not able to increase the productivity? I understand it is rain dependent, but last 2 years, the rains have been pretty decent in Eastern Africa, but still we are not seeing improvement in productivity. Your views on that?
So there are places where the government and the industries are doing much better, but there are places that are still struggling. But the main challenge in Africa is being able to match the milling investment versus cane development. So most of the time it's imbalanced. So there are these good plans, but you need to be able to expand your production in terms of sugar output. But you go up and put massive milling capacity without matching it with cane development. So what happens, especially in Kenya and Uganda, you notice in some years when the factories can't have enough to sufficiently crush, then they resort to harvesting immature cane, very young cane that would mostly be seed cane in most of the years. So when that happens, then the recoveries drop, and it kind of negates the general agenda of growing the industry. So that, together with the over-dependence on rain-fed agriculture, is really damaging parts of what would have been otherwise very good plans. But generally, East Africa is rising. If you look at what's happening in Tanzania, in Uganda, in Kenya, we are having record production in Uganda, and we're expecting another record year next year. 2026. So we have a record in 2025 calendar year. We're expecting another record high production in 2026. Tanzania is also going to achieve a record high production of close to more than 500,000 tons during the 2025-26 milling season. Kenya had quite a dip in 2025, but we're expecting the crop to rise. Again, I have to mention that this is weather permitting. If the weather turns out to be very dry past mid-year, then this could be affected. But as we look at it today, we think Kenya will also be better. So generally, there's an improvement, but it's punctuated with some dips because of the imbalance in matching the milling asset versus cane production.
Perfect. So Willis, now last question to you, before we let you go, and thanks a lot for explaining, the challenges of achieving self-sufficiency. We know that across the world, it is easier for politicians and governments to talk about it, but to achieve it, you need execution on the ground, which is done by the private sector, and they have their own challenges. How do you see that, numbers for India, because as you said, the production is going down, and we are the next door neighbor, just hop across the Indian Ocean, and we are there. What numbers do you see that there is a possibility for East Africa to absorb India's export? And as the prices are pretty low globally, I think Africa being price sensitive market, do you see a serious increase in the imports in Africa for Indian sugar?
I think it will be different from region to region. There are sections that are going to perhaps have a lower demand in 2026, but there are others that will have higher demand. Like definitely we're expecting lots of imports into Somalia, Djibouti, Ethiopia, that pocket. We're expecting Libya to continue ramping up. But if you look at the 5 countries that formerly were the former East Africa Community members, that is Kenya, Uganda, Tanzania, Rwanda, Burundi, and South Sudan, you notice the crops will be big, or rather they're expected to be big in 2026. So we expect, we don't expect, say, Tanzania to open up for world market brown sugar imports like they did in 2024 and I think early 2025. We don't expect Kenya to open up for duty-free imports from the world market like it happened in 2023-24. So that demand is not going to be present. But if you look at areas like Burundi, Rwanda, these are markets that are consistently importing, and it's all about the price. So we will see Indian sugar moving to South Sudan, Rwanda, Burundi, Eastern DR Congo. Those places are still available. So it's going to be a reduced volume in 2026, but that could change in the future years. So more demand would come in the future.
So actually, the question from my friend Ravi, who has just joined, and actually he's Executive Director and CEO of Renuka Sugar. He's having keen interest in Africa. So Raviji, why don't you yourself ask the question? Let's have because something of interest to you.
Yeah, hi Willis. One of the best presentations I have seen on Africa. Congratulations. And I just had one question that Kenya is going out of COMESA agreement. What impact do you see on sugar market for that?
Hi Ravi, it's a very tough question, that one, and I may not be able to speak exclusively about it, but I'll share a bit of thoughts. So
yeah, sure, thanks.
What has changed is actually the cap that Kenya used to have for COMESA sugars. Initially, we used to have a cap where we can only import a max of 350,000 tons of brown sugar from COMESA in a year. So once that has lapsed, then we have to go for other sources. Like if the crop is so bad that Kenya needs, say, 500,000 tons, then it will pick another 150,000 tons from elsewhere if the COMESA position is already used up. But what has changed now is that cap is now officially removed. So Kenya can decide to import 1 million tons from COMESA, and it all comes in. But in terms of execution, I think it all stays the same. For one, the Kenya Sugar Board still regulates what comes in. And of course, if anything, what could maybe go out in the future. At the moment, Kenya doesn't export anything. So because they would issue permits to any importer that would want to bring sugar into Kenya, they are able to regulate what comes in. So it's not like Kenya's removed a cap on COMESA, they're going to import more sugar. It's not straightforward because it will depend on need. If there's a need to take in more, they'll take in more. If there's a need to take less, they'll take less.
Thank you very much, Willis.
Okay, thanks a lot, Willis. It was pleasure having you, and thanks a lot for giving the African perspective. Because back home in India, with the 1.5 million metric ton of quota available for us to export, right? There is a lot of interest in seeing like how much of it can be consumed by Africa. Africa being, I would say, India's logical partner. Thanks a lot. And with that, I would like to move to our eminent speaker, Mr. Ravi Gupta. And in fact, he is one of the sharpest minds. In fact, Raviji, before you join, me and Sanjeev from Olam, we were discussing the great work Renuka Sugar has done from becoming just a processor or just a trader to something which is a house of sugar, where you are touching every aspect from all the way from the farmers to value-added product for the consumer, and also being one of the top exporter out of India. So we were looking and understanding, right, the great work Renuka has been doing, and that was, I would say, something which we all appreciate, and you being part of it and you being driving it has been I would say instrumental. And we are lucky that we talked about Renuka Sugar's case, and then I'm having, I would say, that the horse in the room who actually drove the cart forward. Apologies for using a horse. I think you are more like a tiger or lion, but I think
or more like an elephant.
No. So actually, because carts are pulled by horses and the best of the breeds, and that was the reason. So I know no, you don't need an introduction because everybody knows you, but still I'll take liberty of introducing you. While I can introduce you for an hour, but I would try to be short with the time constraint which we are having. So Mr. Gupta, he's a heavyweight in the Indian sugar and ethanol sector, serving as executive director of Shree Renuka Sugar, a Wilmar Group company. He stands at the forefront of India's sugar and energy transition, managing one of the largest refining and distillery operations as well as processing of sugarcane operations in the country. Ravi is a key architect in executing also India's E20, that is 20% ethanol blending mandate. His expertise lies both inside and outside the mill gates, balancing the complex economics of cane procurement against the volatile realization prices of sugar and ethanol, making him a definitive voice on the industry's commercial reality. Thanks a lot, Ravi bhai, to join us.
It is indeed my pleasure, Deepak. And before we go any further, I must congratulate you for your vision about know your commodity as a channel and as a source of information. I must congratulate you because in such a short time, you have created such a big community, and each event which you do is in fact helpful in one way or another to everyone who is part of this community. So I wish you all the very great success in this. And I must say that you are doing a lot of work for us, and we are very happy about it.
Thanks for the kind words, sir. It increases in accountability to be better every time. Thank you.
Exactly. It does.
Right. So, sir, coming to the first question, it is about ethanol parity. So we have seen that government is pushing E20. Is the current procurement prices for ethanol sufficient incentive for the mills? Because I think we are having this differentiation of the feedstock. We are having maize is priced at high, sugar cane or which syrup or molasses based sugar is priced low, and that creates unnecessary, like I said, distractions, right? Do you think with the current price points, sugar industry is short charged by the government currently?
So, Deepak, I will answer this question with a little bit of background. So, for the sugar industry, there are three feedstocks as far as ethanol is concerned. One is we use sugarcane juice directly to make ethanol. Second is we use intermediate molasses, which is called B molasses, for making ethanol. And then there are final molasses. So the government fixes prices based on each feedstock. So there is a different price for sugarcane juice ethanol, different for B molasses ethanol, and different for C ethanol. So as far as C molasses ethanol is concerned, which are final molasses, I would say that the prices government has increased last year also, and it is still in line with what it should be. But the bigger focus is required, particularly on sugarcane juice ethanol and B molasses ethanol. Sugarcane juice ethanol is an easier calculation because let's say 1 ton of sugar will give you something on 600 to 650 liters of ethanol. So given that the prices which government is giving today needs revision strongly, because that price, which is 71 rupees, does not give the enough realization to recover the cost of sugar also. So it definitely needs a revision. The industry worked out the sugar costs around 41 rupees a kg. So based on that, the prices of ethanol should be minimum 77 rupees a liter, which is 71 today. So that definitely needs a revision.
Right. So actually, when we also talk about the pricing of sugar, as you rightly said, and ethanol, right? Both needs to be looked at specifically for a company like yours, which actually plays in both the areas. According to you, even we have been talking about these export quotas, and export quotas are very important when we are having surplus situation like what we are having today. Now, unfortunate reality is that this whole quota system, right, it put this in a disadvantage. The efficient players like maybe Renuka Sugar, which are, I would say that ensuring that their logistic infrastructure closer to the port, all these things are I would say that competitive advantage are pushed just because we want to distribute these quotas, and then the quotas being asked for a premium. So all these confusion. Don't you think that the better model has to be in case you want, give a quota and make it OGL?
See, the issue there is that if you would do OGL, I mean, there are pros and cons of each step you take in the sugar industry. So the problem with OGL, which everybody had envisaged, is what if the exports are more than, because when it is OGL, it is very difficult to control it. You will only know the post facto, and we do not want to come into a situation that we export more and the later on the country has to import. That kind of situation is best avoided. So to control the quantum of exports out of the country, the quota system was started, and each mill was given a certain quota, and that was, let's say, government want to export 1.5 million. So out of that every mill got its own quota, so that the sugar which is released from the mill is not more than 1.5 million ton. So I would say that both have pros and cons. OGL has disadvantage because then the stop and start is very, very sudden, and which world market doesn't like. At least with this system, we have a proper control on the supply and demand. So that is where I agree with you that there are disadvantages because, in the case of OGL, everybody can participate freely. A trader can also export, a mill can also export, and the most efficient export faster. But the problem which comes is, as I explained, is that if you suddenly see that the exports are more and you suddenly stop, contracts goes into default, and then it becomes a little bit mess. So I would say that as far as system of quota is concerned, it is not as bad. And this quota is also transferable. So one mill can sell their quota to someone else who wants to buy it. So that is the background of export quota. But going forward, as the year looks like next year, probably our surplus will be much more as one can see it. Then probably there will be a merit when we are exporting more than 3, 4, 5 million tons of sugar that we started OGL, because then this system of quota system may not be very efficient.
Yeah, so I think we can have this dual process where actually just like we do for many of the commodities, right? We can put it in OGL and then actually we can always control it, right? Before the season rather than post season, whether to put it in OGL or not. Because see, last year, sir, we had quota for close to 1 million, but we were able to only export 0.8 million. And many of the company, I would say organization like yours would be having capacity to export it.
So you said it very rightly. There used to be a system, Deepak, in which anybody who wanted to export had to go to the ministry and obtain a release order. So release order became a control as far as sugar exports are concerned. That is something which is also feasible, where whosoever wants to export, let's say A wants to export, he signs a contract of 10,000 tons, goes to ministry, get a release order given to a particular sugar mill, and that control can also be established. So probably for the next year, when our export will be big, probably these kind of system should be evaluated most definitely. And I agree with you, the system should be such that it is much more efficient so that the most competitive can go outside.
Yeah, because see, actually with technology in place, right? These controls can be done like online application approvals and
You're so right. You're so right.
So because see, I see a scenario where with 1.5 million metric ton quota this year, and which has been also talked about 500,000 to be added more, it might not end up where actually because of all these small things, we again are not able to utilize it, which is not good for the industry as well as it is not good for the country as well.
I fully endorse what you say. Fully endorse what you say. In fact, as you very rightly said, today with the technology, getting the release order, getting the quota release are all can be done digitally, and it can come very, very fast. And that is something which we should consider for the next year, for sure.
Then because a small countries like, the UAE is able to make all these things so automated and so straight through process, where actually we being the IT superpowers of the world, if we are not able to leverage the real time.
Let me just tell you that for terms of digital and IT infrastructure, I think our Ministry of Food has done a wonderful job today. Basically, the DFPD has detail of their system is, it is kind of synced with these ERP system, the sugar mills, and they have minute-to-minute information about the production, dispatches, and everything. So that way, IT has been fully utilized. And as you very rightly said, we can further enhance the digital capabilities which has already been made up by making the markets more open, by having a system that whosoever wants to export just digitally asks for a quota and he's given the release.
Perfect. So now I'll go to the next question, where actually your intelligence is most important. So we had Kona today also talking about the global outlook and the numbers, and you have also happened to be traveling across the globe and engaging with a lot of stakeholders, including definitely the business you are doing. Sir, how do you see the global outlook? We have seen the prices which were.
See, it's very so. I think Kona is very capable, and I respect her for her views. I didn't hear her. Session. So I'm sure I do not want to be kind of get into a situation that where I say that my expertise is more than Kona. No, not at all. She's very capable. But in nutshell, I will say that the world is going towards surplus. For the first time this year, we will have surplus in the trade deficit because Brazil is likely to produce more. India is producing much more than the last year. Thailand, we have a positive outlook on the crop. China, minute by minute, is kind of, increasing its production year on year. And EU also there is a production minus consumption. There is a kind of surplus in the world market. And so far, it was okay till December because, the Thailand production and EU production had not come in. But I think going forward, we see the surplus both in the raws as well as in the whites. And next year, I think the surplus will be even bigger because we expect that the Brazil will produce more than this year. Also, given the normal monsoon, I think India 26-27 will be much larger crop. So overall, we are seeing a surplus kind of scenario building up.
And sir, in this surplus, how do you see the price movements? Because we have seen that we are 25% below what we were last year in international prices, whether we talk about IC or whether we talk about London prices. So do you see any recovery? Because there is a little recovery, not much, but from the bottom, rock bottom, 14 cent per pound to we are at 14.9 now at least. But do you see that actually there is even little bit of more chances of any improvements or?
You see, Deepak, I generally avoid making any flat price comment, but I can only see is that next year the surplus is increasing out of the most efficient countries like Brazil. So there is always a tendency in the world market that it's like law of economic and marginal cost is equal to marginal revenue. So since there is a surplus and the surplus is also coming from the countries which are the most competitive producers. So I think market may still have to do much more job to cut down the production and probably 14.9 if it stays very good, but the bias would be that there is still room for the market to go down.
Perfect. So in this scenario, when the international prices are low and domestic prices, they are still held steady as of now. If we see that, we are at 37, 38 odd. That is what last numbers I was having. Do you think that to ensure that there is a viability of export, some support, I would not say directly, maybe subsidies or incentive, some support from the government is required to take care of the excess surplus which we'll be having in sugar this year in India?
See, I mean, principally, it is not a good idea to subsidize exports per se. My theory has been that India has in a beautiful situation where it can use its surplus sucrose for ethanol. Like this year, our ethanol diversion is close to 3.5 million tons from sugar. and which can easily be taken up to 4.5 to 5 million tons. So I would rather suggest a scenario in which we increase the prices of sugarcane juice ethanol and maximize the diversion of sugar to ethanol. That would be very helpful rather than subsidizing for the world market, rather than subsidizing sugar for the world market. This is the scenario which we wanted to avoid, and we very successfully avoid. I will take you back to the year 2016. The sugar stocks were very high. We were at a 14 million ton of opening stock, roughly around 6 to 7 months stocks. Cane areas were 20,000 crore rupees that time. And the government very, very rightly thought about starting this ethanol blending program. At that time, by the way, we were giving also export subsidies. Then after that, government thought that it is not a good idea that surplus sugar is subsidized and exported. Let's start the ethanol blending program. And since then, we never had to get into a situation that we had to subsidize exports. Now the surplus has again come back. I think we should focus on diverting more sugar for ethanol and increasing the ethanol blend, as well as introducing the flex fuel cars so that our ethanol consumption increases and we do not have to export sugar on the with the subsidy. That is the scenario which is much better, because the model of subsidy per se is not good.
No, I totally agree with you on this, Ravi bhai. Actually, because if you see that the leaning of the government to move from the sugar-based ethanol to grain, because as you rightly mentioned, in 2022-23, out of 5.5 billion liters the OMC purchased, 3.3 billion liters were from the sugar cane. And now we are having a situation that when they are buying 10.5 billion liters, still only 3.2 to 3.4 billion liters are being taken care of by sugarcane. So in this scenario, I totally agree that we have to identify the ways we can increase the use of ethanol and divert sugar. And that, as you rightly mentioned, one is the flexi carb, but don't you think that's a typically long term? And with the type of I would say pullback which is having, 27 might not look very viable currently, the E27.
See, there are two things here. As you very rightly said, flex fuel definitely is the medium to long-term alternative. It is not going to work in next year. But for the time being, government has many options. One of them, which is a low-hanging option, increase the blended gradually from 20% to 23%, which will not cause anything great. So 3% increase in ethanol demand itself is quite sufficient. Then also there is a possibility of blending ethanol into diesel, which is up to 1%, because diesel consumption is 3 times of petrol. Right. So that also is quite possible. So there are various possibilities and solutions, and we can definitely consume more, 1 or 2 million ton more sugar easily diverted to ethanol and create that demand. Absolutely without a problem.
No, I think that is what the government should be doing, because it is
that is what actually government is also constantly working on. That how do we increase the ethanol blends, either by increasing it from 20% to 23%, or also exploring mixing up with the diesel. So that is a low-hanging fruit. Parallelly, from medium to long term, several projects are going on. One of them is also sustainable aviation fuel, where ethanol can be used for sustainable aviation fuel. But those are medium and to long term situation. For the immediate, I think these are the low-hanging fruit which India can easily adopt.
Perfect. Thanks a lot, Ravi bhai. It's always a pleasure and honor to have you as a speaker with very clear-cut agenda, which what industry can take and move forward. And what you talked about ethanol, I think rather than giving incentives for export, it is better that actually we keep our sugar with ourselves, convert it into ethanol.
Oh, absolutely, absolutely. Because incentivizing, when there is a scope of consuming within the country. Right. Then incentivizing exports, something is the last thing which we should do. And particularly for a country which is 85% depending on imports for their transportation fuel. I mean, it is absolutely doesn't make any sense to, export sugar and then import crude oil. I mean, you export the green energy and you import the carbon energy. So it doesn't make any sense.
Perfect. So thanks a lot, Ravi bhai. Just be with us for another 5 minutes, because we are doing a small, I would say, announcement also.
Very great.
So, yeah, so this announcement is that actually, first of all, I'm delighted to share that HnyB, which is our parent company, has entered into a strategic partnership with a company called AgriGuru Online Trade Private Limited. The collaboration brings together two organizations that share a common belief that future of agriculture, especially agriculture commodity trading, must be data-driven, transparent, and technology-enabled. Along with this partnership, I am personally honored to join AgriGuru Online as a co-founder as we work together to build a technology-powered market intelligence platform for our commodity community. Our collective vision is clear: to leverage AI, data analytics, and digital platform to solve real-world challenges faced by traders, exporters, importers, and agribusinesses, from price discovery and market volatility to trade efficiency and informed decision-making. The journey would not be completed without strong leadership and vision of Dr. Hansa. She's our co-founder and she's also director of the company, whose extensive academic and industry experience spans technology innovation and agri-tech leadership. Dr. Hansa brings a passion for integrating cutting-edge digital solutions into agriculture trade, pushing forward market accessibility, transparency, and efficiency for participants across domestic and global landscapes. It gives me great pleasure now to invite Dr. Hansa to share a few words about AgriGuru Online.
Thank you, Deepak ji, for the warm introduction and for the providing this wonderful platform to formally announce our partnership. On behalf of AgriGuru Online team, I want to express how truly grateful and privileged we feel to have you join as a co-founder. Your experience, vision, and leaderships and add immense strength to our journey, and we are incredibly excited about the path ahead. While working closely with agri-commodity trading community, we identify the fundamental gap. The gap is like first, the reliable and transparent commodity prices. Whether we talk about FOB, CIF, or CNF, are rarely available on the single unified platform. Today, traders are often forced to rely on the fragmented sources, informal networks, and outdated informations. Equally critical is the freight price. It plays a decisive role in every trade, yet it remains one of the most opaque and unpredictable element of the global agri trade. Furthermore, when the process of or prices of the freight are aligned, the success of the trade depend on the heavily on the accurate, timely documentations. A process that remained complex, manual, and error-prone for many participants. So, AgriGuru Online was founded to solve these exit challenges in the market. Our vision to provide a one-stop solution enables technology-enabled solution that bring together real-time market price, freight insight, a smart digital documentation to ensure the seamless and successful trade. Through this strategic partnership with HnyB and with the Deepak ji leadership, we look forward to building the future of agri-commodity trading industry. So before I conclude, I want to invite personally to all to visit all of you at the Gulf Food this year. We'll be having a stall at hall number 6. The stall booth number is N6 and C2 from 26th January to 30th January at the Dubai. We look forward to meeting you all there and discuss how we can grow together. Thank you, Deepak ji. And over to you.
Thank you. So, Neeraj, if you can just run through that the sample reports which recently will be launching at the Gulf Food. Can you do that, please?
Yes, just a minute.
So, Ravi bhai, you will be at Gulf Food by any chance?
Yeah, I'll be in the Gulf Food. Maybe for the last day. And I was just listening to Dr. Harsha. I think it is a great initiative. And I wish all the great success to this venture. My only thing is that today, the information is required at the grassroots level. So whatever information you make out of this organization, don't only make for the traders or the buyers or the sellers, make it for the farmers as well. And there is a reasonable big interest among the farmer community to know what's happening around, because today the farmers are not the same farmer who was there around 50 years ago. The literacy rate has increased. The mobile connections are with everyone, so everybody is interested to know what is happening. And maybe it might be a good idea to make these reports into different languages so that the farmer can easily read out. It can help a lot.
No, so we are planning to do it in 13 vernacular languages eventually.
Wonderful.
And deliver through WhatsApp to the farmers, so they don't even have to get into complicated activity. They would be able to just register and then actually they can use that service. So so my heart is always with the farmers. So definitely this initiative.
No, this will be very good. This will be very good. This will be very good.
Yeah. Neil just run through that the recent report which will be sharing in Gulf Food. Yeah, please go ahead.
So is it visible?
Not yet.
Not yet.
Loading. It's loading.
Okay, now we can see it. Yeah.
Yeah. So thank you, Deepak ji. Thank you, Dr. Hansa and Vikram Bhai for joining. So basically, this is the sample report. So the data and prices are for the representation purpose only. So as Dr. Hansa mentioned and we discussed, it's not only about the pricing. We want to create an intelligence platform which covers the latest market happenings, supply demand shifts, policy related implications, and as Ravi sir suggested, the point of view related for the farmer as well. All combined, analyzed for their impact, which is directly for the trade decision. A very strong component is also along with the pricing is as you can see on the screen is the freight pricing. That pricing of freight rates are very important for the intelligence.
Neeraj, I think we have lost you. Can you hear me?
No, I think some issue. But anyway.
Yeah, sure. So we thank all of our participants to be there and take this initiative of Commodity Week. And Ravi bhai, this was our last session. We had great 5 sessions. This was 6th one. And looking forward to see all of you. If you are visiting Gulf Food, I will be there. Let's engage. And till the next time, thank you. See you soon.
Thank you, Deepak, for having me. And I wish you a great success on this new venture as well. And my congratulations and my best wishes. Thank you so much.
Okay.
Thank you, Ravi.
Take care.
Thank you.
Thank you. Bye.
Thank you.